Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
I'm Alix alongside Paul Sweeney. Welcome to Bloomberg Intelligence Radio. We are broadcasting to you live from Interactive Broker Studio right here in Midtown Manhattan. Also check us out on YouTube as well. What do you do in the market? The NASDAQ 100 is up by 2%. It has been an extremely difficult week in the market, if you count last Friday, just in terms of understanding where we are, where positioning is, and is the market complacent? I mentioned the VIX at 25. Joining us now is Bryan Whalen, Chief Investment Officer and a Generalist Portfolio Manager over at TCW, joins us now. Hey, Bryan, are we complacent here at this point, or is this a buying opportunity?
I think it's a buying opportunity in the bond market. We've had a little bit of a backup. I think everything we saw, earlier this week, Sunday night into Monday, was a bit of panic. We've been in a very bearish camp with regards to the economy, but even we're dismissing the notion of some intermediate cut. We thought that was a foolish way to think about the world. So I think this is kind of calm. This is the market kind of settling in here a little bit. Even though we've backed off in bond yields since the lows on Monday morning, if you just take a step back for a second, the 5-year as just kind of an indicator of yields has come down 50 basis points since we started the quarter. So since July 1, and that's a big move. And I think that's very much in line with the notions and everyone in the fairy tale camp of no landing kind of being shaken a little bit. We've seen a couple months of slowing economic data. And the one economic kind of data point that had been holding up that no landing camp, which was the headline payrolls number, that got knocked off a little bit on Friday. And so if you kind of forget the noise early in the week, this looks like kind of the right place to settle in.
Bryan, when you walked out onto the TCW trading floor on Monday morning, what were your traders telling you?
It was, metrics didn't make sense. Things were moving all over the place. Liquidity was very poor. You saw the VIX, I think at one point it was at, intraday was well over 50.
It was 60.
Which looked, it was in the 60s. Yeah, it looked more like an absolute, it looked like a stock market crash. It did not look like a market where headline employee, the rate should have been 175,000 growth on the payrolls number, and it came in at 114,000, and the unemployment rate went from 4.1 to 4.3. I mean, that's indicative of a slowing economy and a slower labor force, and maybe one that's weaker than the market was expecting, and it probably will cause the Fed to have to cut more aggressively than the market was pricing beforehand. But it sure wasn't panic.
Well, what did you make of the 10-year auction yesterday? It wasn't good. It just was pretty bad. We get the 30-year coming today. The 3-year was fine. Ira Jersey tells me I should care about these things.
I know.
What did you make of that?
It's the same thing I make of this morning. It's gappy price action. It's a nervous market. I mean, you saw, a little bit of supply. The street pushes it around. You got a higher yield this morning. Initial jobless claims come in just a hair under expectations, although the 4-week moving average keeps moving up. Continued claims continues to stay high. So the fact that we're off 10 basis points in the market is it's a market trying to find its footing, almost trying to like catch its breath a little bit, which is a healthy thing. I think what we would contend is, this is maybe not the breath you take because everything's going to be all right. It's more like the breath you take before you take the punch. And so, over the next few months, what we're probably going to see, at least we expect, is more of the same, which is the economic data continuing to slow, and the Fed's going to have to react to that.
Bryan, where do you see opportunities in the fixed income market here, given some of the volatility we've seen over the last several days?
It's a boring answer. I'd say the opportunities, maybe an agency mortgage aside, but at a high level, the opportunities is in duration and in liquidity. Like keep your powder dry, because not saying we're going to have VIX days of north of 60 again, but if we enter the fall and the narrative, and you start reading more about a recession, and the job market turns from one of where companies are just not hiring but actually starts to fire, what you're going to see then is concern about earnings growth and the ability of companies to service their debt. And then there's going to be conversations around downgrades. And what happens then in terms of pricing and like our trading floor and the opportunities we're looking for, corporate bonds are going to get cheaper relative to treasuries. High yield bonds, emerging market bonds, they're all going to get cheaper. And that's a really nice buying opportunity, because in the bond world now, not only can you kind of buy cheap credit and get the benefits of spread duration, and that's another conversation, but you can also get carry, and you can also get the advantage of like diversification in your portfolio, because, with yields across the curve right now at 4%, bonds can be bonds again. So they can act as that hedge and that offset into an environment where we get volatility and equities decline.
So two things with corporates. One, we saw a record amount of issuance yesterday in the investment grade market all year. And then also the spreads have not blown out at all, like in the last few days. Yeah, they moved up, but we haven't blown out. And I'm just wondering if there's more price depreciation here to come.
Definitely. It's $1 trillion, a little over $1 trillion of issuance year to date, which is very high. But yeah, look, like just to put things in kind of context for everybody here that doesn't watch this stuff day to day. I mean, investment grade corporate bonds kind of on the tight end, meaning like the amount of yield you get over treasuries, doesn't get much tighter than about 0.8%, 80 basis points. We're sitting at about 100 basis points. Historical averages, just even excluding like big moves like the great financial crisis, historical averages are about 120, 125 basis points. So, that was kind of us too on Monday, when it's like, look, the market, everybody's got to calm down a little bit. Like, at 100 basis points over, corporate bonds still look expensive. So be patient. This may not be a recession that we kind of jump into in an overnight. This just may be an old-fashioned recession where we're just going to have to walk our way into it. So as an investor, you got to keep that kind of long-term perspective in mind, and preserve that capital. If you've got that cash, that's worth a lot, because you'll be able to spend it in very wise ways, probably throughout the remainder of the year and into early next year.
So, Bryan, when the phone calls do come from Wall Street with these new issues, what kind of calls do you take? Do you take everything? I mean, because you've got capital to deploy. Yeah. Are you focusing just on the highest quality stuff? What kind of phone calls do you take from Wall Street these days?
I think the way I've described it is like, don't call us when you think we need you. Call us when you need us. That is like the good way to describe what we call like the liquidity premium, which is, and I was talking about cash before, like, you want the opportunities when people are calling you on the phone and saying, we've got a problem, or somebody needs to sell, and et cetera. And it's like, okay, what you hear seems like going on to like a dealer's like car lot. Somebody's like, look, I got to get rid of this thing, blah, blah. Same thing. Like, as an investor, you want to wait for the opportunities where Wall Street calls you and says, look, here's an opportunity. Here's the price. I know where regular market pricing is. And, what do you think? And that's what you wait for. It happens kind of infrequently, but that's where you can make the big money.
Where do you think we're going to see the most volatility?
Oh, that's a good question. In the short term, we'll see it and obviously in interest rates. I think the next thing would probably be your what we call these high beta parts of fixed income, like high yield and emerging markets. I think down the line, so the public liquid markets will react first, and that's where you will see the vol. I'll also throw, we'll probably see some currency volatility in there too. But down the line, if we do get a true recession, there'll be a shakeup, in everybody's favorite market today, which is private credit. And there's some, private credit's here to stay, and there's some great things about it. However, it's been too easy for too long, and there's going to have to be a shakeout. And that's a healthy thing for the market in the long term. And so in the short term, focus on those kind of liquid markets like high yield bonds, for instance, currencies. And then in the longer term, that'll probably roll into less liquid parts of the market.
All right, Bryan, thanks so much for joining us. Really appreciate it. Bryan Whalen, he's a Chief Investment Officer. That means he's a big dude, and a Generalist Portfolio Manager at TCW. I tell you, I've worked with TCW when I was on the sell side, 20 some odd years. I had like 4 or 5 good relationships there, all really smart.
Super smart.
Yeah, I mean, like across the board. Like I avoided the fixed income floor like the plague. I went to the equity floor because that's more.
So I think that people are really smart when they can break things down in language that I understand. Right. Like that's the pure sign. Like you're so smart, you can dumb it down.
Right, and that's how Bryan Whalen.
Paul's guiding principle was, where can I make the most money?
Where can I make the most money?
As he should.
Exactly.
As he should.
I tell you, go to Los Angeles. There's 2 meetings you have to get: TCW and Capital Group. Everything else is just gravy. If you get that, that's like 80% of the votes, 80% of the commission dollars out of those two shops.
Yeah, duh, Tucker. God, you didn't know that. Jeez.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
All right, let's check in with our good friend Claudia Sahm. She's a chief economist at Century Advisors, former Federal Reserve economist, and a Bloomberg Opinion columnist. And she's got this thing called the Sahm rule. Now, I'm not an economist. I think marginal revenue, marginal cost, that's my extensive knowledge of economics. Claudia, thanks so much for joining us here. Can you just summarize for our listeners, our viewers, what the Sahm rule says, and was it triggered on Friday with the jobs report?
So it's a recession indicator. So it uses changes in the unemployment rate over a year to, it has a threshold and compares that to historical episodes of recessions. And, that's when it turns on, it has turned on historically in the early months of, not a forecast, in the early months of a recession. And with the employment report on July, the Sahm rule crossed the 0.5 percentage point threshold. And so it's indicating a recession. Are we in a recession? My expert opinion, looking broadly, is no, we are not. But that increase in unemployment rate that we have seen over a year plus is very disconcerting. Mm-hmm. Right? We're not pointed in the right direction in terms of where we're trending.
This is why I really loved your Bloomberg Opinion piece yesterday, because it feels like a lot of people are coming on talking about your rule and how that is de facto then we're in a recession as reason for the Fed to do something maybe bigger or an emergency way. And you come out with an article that says U.S. isn't in a recession, despite the indicator. My recession rule was meant to be broken. What does that mean?
When we think about this cycle from the pandemic on, the last 4.5 years, the disruptions to the U.S. economy have been in many ways unprecedented. And in particular, we've had some really big disruptions to supply, which are typical boom and bust indicators: recession, high inflation, low inflation. Those are about demand. And so the Sahm rule, in my opinion, is getting overstated by some of the really abrupt shifts in labor supply in the last several years. And that's just, some of the unemployment rate increase is the good kind. It's people who've come in, want to work, they will get jobs, it'll be growth. But in the interim, that looks like the unemployment rate rising. In the recession, there's some of the bad unemployment in there too. So that's where it gets really hard. And, it's difficult to hear. I'm happy to have sparked a robust conversation. This is really, really important to know if we're in or headed towards a recession, because there are policy actions that can be taken. And so, I'm using the tool and other data just like anybody else.
So, Claudia, what do you make of an unemployment rate of 4.3%? To me, in my experience, that's still low. I guess if you want to get concerned about the trend, i.e. it's moving higher, that's a concern. But in and of itself, 4.3%, how does that kind of stack up for you?
Right. So if our concern is about the direction we're pointed in, are we headed towards a recession? Are we in a recession? The relevant metric is the change in the unemployment rate.
Okay.
I mean, the level is important. Sometimes it's unsustainably low. Like earlier when we had the labor shortages, the unemployment rate in the United States, when it got down to 3.4%, that was because we were missing some workers too, right? Like that wasn't going to stick. So sometimes, within bounds, sometimes the level does tell us something. But at 4.3%, this is very much consistent with the demographics of our workforce. We have an older, more experienced workforce. 4% unemployment, that's much more like you would expect or predict. So that 4.3 is not like, oh, wow, this is really low.
Right.
It's not sustainable. And we've gone into recessions in the past with lower unemployment than now and also higher. So the level itself is not a protection against a recession.
Paul pointing to himself when he said older workforce. Seasoned. We think seasoned. Experience.
Yes.
Claudia, to that point, how do I understand the fact that you had a huge move in the bond market when initial jobless claims came out? They're volatile, they're seasonality, they change, and yet we're having such market sensitivity to that. Where does that kind of tell you about where we are?
Right. Well, this is very much this question about the dynamics, the recession, right? This isn't about the Sahm rule, but it captures it, right? This is why this almost worked historically, is you get periods where the unemployment rate starts coming up gradually, and then it picks up steam, and then it goes up a lot. And we had some signals that we're in this stage. It's been going up slowly and gradually. And with the July employment report, things looked like they were picking up steam in the wrong way. And so that's the concern. And then what we're looking for in claims data is that momentum there? Or was it just the weather or this or that? And so I think that's this reaction because we're kind of on this. It's not like we're on the knife's edge, but the dynamics are like it makes a big difference at this point if the increase in the unemployment rate speed up or not. Because once they get going, they tend to, you have these negative feedback loops. And then you're not talking about a 0.5 percentage point increase in the unemployment rate, you're talking about a 3 percentage point increase.
Wow. Claudia, talk to us about the migration component to the labor market. How has that impacted the numbers? Because again, we've had a surge in migration on the southern border for the last several years. How's that impacted the numbers, do you think?
Right. Well, first thing, having the immigration, and we've had other prime age labor force participation is higher in the U.S. right now than it's been in general. So it's not just about immigrants, but it was very important to have more labor supply address these labor shortages that we'd had, and this has taken pressure off of wages and inflation, and so that's very good. And then we have more supply of workers, and hiring has moderated, right? The pace has slowed down some. So now we're in the opposite direction of the jobs need to catch up to the workers. So if you think about this is all an adjustment, right? It's more of a timing issue. And when the reason that the labor supply causing increase in unemployment rate is a good thing is when those new workers do get jobs, they help us expand the economy, which is the exact opposite of this kind of recession watch contracting. But I will say, employers have different margins to adjust labor demand writ large, and we have seen the hiring rates at employers come down to levels that are, line up with much higher unemployment rates than in the past. So it could be just employers are not wanting to lay off as much because they got burned in this crisis. And so we're seeing, it's harder if you're coming in labor force to get jobs. So this is a really tricky labor market to read. And that means every single scrap of data we get on the labor market could cause a big deal.
So Claudia, before we let you go, we have about a minute left. I'm looking at WIRP, WIRP on the terminal. It's looking at 25 basis points of cuts in the next 3 meetings. Is that fair pricing right now?
That is my baseline. I think that's fair pricing. The Fed, there is more slowing in the labor market than I think is comfortable. We don't need to get into a recession for the Fed to start acting. So I think a little picking up the pace, some and 3 consecutive cuts makes sense, but they're going to be very attuned to, we've got more information on the labor market between now and September.
All right, Claudia, thank you so much for joining us. Really appreciate getting some of your time. Claudia Sahm, she is the Chief Economist at New Century Advisors, former Federal Reserve economist, and a Bloomberg opinion writer, so we appreciate getting some of her time. She's the creator of the Sahm rule, a recession indicator, which says maybe it's not tripped today, but it's certainly suggesting that the risks of a recession are higher, certainly in the near term.
But I love her candor of look, I think some people are taking this and running with this a little bit too far. There's some more nuances. I love that because you don't get that very often, particularly in a market that for so long appeared so one-sided in terms of positioning, that kind of nuance is quite important. And I have to wonder, how complacent are we still? I mean, that fade yesterday was not a good sign.
No, it wasn't. But again, we got the S&P, up 1.6% here today. The Russell up 1.5%. The Nasdaq up 1.8%. So kind of some broad market moves higher today.
Yeah, and the VIX at 25. I remember those days where it was 12, 2 weeks ago.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Alix here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We keep you up to date on all the business news and economics and finance that you need with our Bloomberg Intelligence lens, because they cover 2,000 companies in 130 industries worldwide. We also like to dig deep into the amazing reporting here that we have throughout Bloomberg News. And there's a couple things on that point. One is we're going to go to Madison Muller, who's going to talk about Eli Lilly earnings, because that was quite interesting. The other is we're going to talk about Ozempic Town. It's a big take. You can check it out on our podcast. You can check it out in Bloomberg Business Week as well. But it's saying it found the biggest town in the United States that uses Ozempic. It was really cool, great anecdotal evidence, and I have lots of questions. Madison joins us now in studio. First, just take us through Eli Lilly earnings. Is this a pure market share grab from Novo to Eli?
Not quite yet. So that's what we've been closely watching. Lilly is narrowing the gap with Novo Nordisk. The sales are coming quite close. I mean, Lilly had 1.2 billion in sales of Zepbound, which only launched a few months ago, and Novo Nordisk had 1.7 billion in sales of its weight loss drug Wegovy, which they reported yesterday, and Wegovy's been on the market for several years. So Lilly is really moving fast. Sales are ramping up extremely quickly, and we are watching closely to see what happens.
I guess the next step for these drugs is, I guess, an oral type of
exactly.
pill. Where are we on that? What are the companies saying?
Both companies have been working on pills, which obviously they think could help not only expand the market in the U.S., but expand ex-U.S., because there are certain markets that research has shown prefer pills over shots. Okay. Japan is one of them, interestingly. So that's kind of the next step here. Both of the companies are studying these drugs. Novo, though, has had a lot of trouble with supply, and particularly making enough of the active ingredient that's used in their drugs. The pill uses the same active ingredient, and it uses more of it. So they're kind of struggling right now. They can't really launch that pill until they get a handle on supply.
Let's go to the big... Oh, sorry about that. Didn't turn on my mic. Let's go to the big take, because that was quite interesting, and it feeds into the whole story. Mm-hmm. And the title is What It's Like When Ozempic Takes Over an Entire Town.
By the way, sorry to interrupt.
Yeah.
Great story.
Thank you.
Thank you. Because I spent a ton of time in Bowling Green, Kentucky.
Really?
I know of what you speak. And I send it to a buddy who lives there. She knows half the people in the article. That's
really?
How small
that's awesome.
Yeah.
So
wow.
I'm just really curious as to how you found this town.
So we worked with the data team on this story, and we got data at the 3 zip code level. So we're looking at, cities and sort of their surrounding areas. And we were looking all across the country. A few other spots came up, like Huntsville, Alabama. And we kind of were digging around to see just if people were talking about the drugs online, if there were doctors in the area that were prescribing them. And we honed in on Bowling Green specifically because Kentucky as a state has the highest concentration of weight loss drug users in the country. So we were like, oh, well, if this city's showing up in our data, this is probably a good place to go and see what's happening. And so started talking to people there, and it kind of spreads like wildfire. You talk to one person who's on the drugs and they're like, oh, talk to my friend, talk to my neighbor, they're on the drugs too. And it just kind of was easy to find people after that.
Why is that? Why is it the use so concentrated in a place like Kentucky? Is that just simply because there's more people there that qualify from a weight perspective?
Right. I mean, that's a piece of it, which is actually a good thing. I mean, we hear so much about the drugs in New York and in Hollywood, but when we're looking at actual obesity rates, those aren't the places that have the highest concentration of people with obesity or diabetes. In Kentucky, there are high rates of obesity and diabetes. There were large employers in the area that were covering the drugs, so people could get access to them. Bowling Green in particular is a very middle class area, so when people couldn't get coverage for the drugs, they were willing to pay out of pocket for it. So that kind of made the conditions ripe for these drugs to take off in Bowling Green.
When you write the article, you also talk about the compound drugs. Can you just walk us through what a compound drug is, why it's allowed, and is it legit?
Yeah. I mean, that has been a really big thing and a really big part of this weight loss drug market as of recently, because and that fits in with this supply issue. Lilly and Novo have really been struggling to keep up with supplies. So when drugs are in shortage officially, these compounding pharmacies are allowed to make similar versions, copycat versions we call them, to help patients who are unable to get prescriptions for the drugs. But what's happened is, in this gap, it's kind of allowed these compounding pharmacies to proliferate, and not all of them are exactly legitimate. And so there's a lot of medical spas that are using the compounding drugs, telehealth companies that are selling the compounding drugs, like Hims and Hers is one that comes up often. And in Bowling Green, it's really taken off as well. There's like all of these medical spas popping up, weight loss clinics popping up that are offering compounded or just illegitimate versions of the drugs. And, that's become a big thing there as well.
Well, for the compounded drugs, are they as effective? Are they safe? What do we know about them?
That's kind of the problem, is because, pharmaceutical products are so tightly regulated and require so many studies from these drug makers, but the compounded drugs are not studied and they're not regulated in the same way. There's not the same FDA oversight. So when we think about, are these drugs as effective? The answer is we don't really know, because we don't have studies that prove that indefinitely.
Why would that ever be allowed? I understand it's a tight supply shortage, yada yada, but then why is it here's an option, take a drug that you don't really know works or what's in it? Why is that allowed?
It's because normally compounding, the reason that it exists is more on an individual basis. So if a person is allergic to a certain ingredient or a coloring in a drug, compounding pharmacies can tailor make those drugs for that specific patient. Or if a drug is in shortage and a person can't get access to it, it's not really supposed to be. They're not supposed to be acting like drug makers, but that's kind of what we're seeing happening with these weight loss drugs because of the demand for them.
Great stuff. Madison Muller, your co-authors, Devin Leonard and Tanez Merjani?
Megani, yeah.
Merjani, okay. That's the big take story today, Bloomberg Business Week. What it's like when Ozempic takes over an entire town. In this case, they focused on Bowling Green, Kentucky.
I did in the story, it talked about how there was a wellness thing, and then you also had Botox next door, because it's a Ozempic face everyone talks about,
exactly.
But you lose all that weight really fast, but then you got all the skin kind of flapping around everywhere. You need the Botox to fix it.
Bowling Green, Kentucky, they make Chevrolet Corvettes, and they make underwear.
Thank you. Thanks for
Fruit
that.
of the Loom is
they
based.
do,
Fruit
yes.
of the Loom in Bowling Green, Kentucky.
Really?
Yeah. So that's what.
Let's
they do
also
there.
go there.
That's also
okay.
Go there.
So we have a
That's
working
the first
list.
Cracker Barrel I ever went to. Bowling Green, Kentucky.
The things
Madison
you
Muller,
randomly learn.
Health reporter, Bloomberg News, joining us live here in a Bloomberg Interactive Brokerage studio, doing some great reporting on these weight loss drugs, which are really, really becoming a big phenomenon within the healthcare space.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's keep going on Under Armour here. The stock up by 20%. Poonam Goyal is Senior U.S. E-commerce and Retail Analyst at Bloomberg Intelligence. She joins us now. What part of this is phew, it could have been worse, versus we really like this stock and its growth?
I think, they're executing, right? This is the start, but make no mistake, they have a long, long way to go. I think the fact that they beat expectations is a good sign that they've stopped the bleeding and it's getting better. But getting to positive sales is still going to be a long while. In fact, before we see actually some meaningful improvement in product, which is a key part of the story, it's not going to be for another 9 to 12 months. So there's still a lot of time. The environment is still very fickle. And, when you look at their guidance, which they did raise, it doesn't suggest that things are getting materially better. In fact, there's a little bit of caution built into the guidance as they expect Asia Pacific region to get weaker. They're having freight expense pressures and also Forex pressures. So it's not all rosy as it seems looking at the share price, but they are making improvement.
What do they need to restructure here? Or do they just need to have more cooler stuff in the stores?
I think it's everything. It's definitely product. Product is king in retail, and they do need to improve their product positioning as well as what they offer. Aside from that, they also have to improve how they market this product. Under Armour has gone through these restructuring efforts multiple times now. So this isn't something new to them. They've over-penetrated in the off-price category. They've over-discounted. They've become basically a promotional banner. And now they're trying to do what they tried to do again previously, is to restructure themselves as a more premium brand. Can they do it? Yes, but it's going to take effort and time, and they have the means to do it. They have the expertise, but remember, they're a much smaller brand than a Nike or an Adidas, so they don't have those deep pockets to help them, but it will take time for them to actually get this underway.
Also, isn't this like a really rough time to try and like be a premium brand?
It's tough, but Under Armour isn't a dead brand, right? Everyone still recognizes Under Armour, and it isn't a brand that has kind of died and is not coming back to life. People recognize the name. People still use it in sports. They have 70 athletes across 28 teams in the Olympics right now. So it's not dead. And yes, it can be repositioned, but it will take time.
So in this part of the retail space that you cover, Poonam, the Nikes, the Under Armours of the world, the Adidas, which is correct way to pronounce it.
Oh,
Alix,
Matt Miller, is that you?
Yes, he's rubbing off on me. How's the consumer there in that part of the world?
So the consumer isn't in the best place today. We've seen the consumer indicators, whether it's the unemployment rate, which we closely watch, is now over 4%. They're lofty. Amazon said it on their call just last week that they do expect consumer volatility and macro pressures to build. There will be more discounting. So, the consumer is choosing, they're being picky, they're trading down, they're pulling back. It's not the best consumer environment heading into the back half.
So how much time do we need to give then, say, Under Armour to fix all of this? Because what is idiosyncratic versus the macro environment? That feels like it's going to draw this process out a bit.
It's definitely going to draw it out a little bit, especially if it worsens. We heard them say that promotions will tick up, which was a major driver to better gross margins in the second quarter. That was really a large part of the outperformance there. But that said, you're talking about a 10% decline in North America, double-digit declines in the quarter still, expecting double-digit declines in the rest of the year, their fiscal year. It's a long way before we can see, continuous positive growth. I'd say, definitely well over a year, if not longer.
Wow. Poonam Goyal, thank you so much. We appreciate it. Poonam Goyal, she is our senior analyst covering all the retail stuff for Bloomberg Intelligence, giving the latest here on our good friends at Under Armour, based in Baltimore, Maryland. Kevin Plank is the founder of that thing. Pretty good story there overall, but as Poonam mentioned, a lot of competition. They need to restructure a little bit there.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Yeah, I'll tell you what's not working today. Warner Brothers Discovery. I don't know. When I covered these stocks, they were ripping. But I don't know, this new generation of media analysts, I don't know what they're doing here. Kevin Year, he joins us here. He's a senior media associate for Bloomberg Intelligence. He works with my good buddy, Geetha Ranganathan, covering the media space here. Kevin, this is a tough one here. I mean, talk to us about what's happening with Warner Brothers Discovery. Taking a big write-down today. What was the write-down for?
Exactly. And thanks for having me on, Paul. It's bad. It's not great. Obviously, we're still in a very transitory period in media. Expectations were certainly tempered coming into the quarter. I think they've been that way for a little while now. Obviously, Warner stopped giving us adjusted EBITDA guidance at the beginning of the year. But that said, it was worse than expected. And it's really, I think the headline is on the network side, as you just said. That's where that $9 billion write-down was coming from. And the visibility isn't great. They're going to be losing, it's all but certain they're going to be losing the NBA contract in 2025-26. So it's really been a game for a long time for traditional media. Can they scale up their streaming services while pay TV continues to melt? But it's tough.
But their streaming wasn't terrible. It was really just the traditional ad business and also the movie business. Like Dune 2, fine, I'll see it. But please, you ain't no Deadpool.
That's exactly right. The ads were really where they were feeling a lot of the weakness as, those linear ad dollars are moving towards connected TV. Streaming was pretty good. They had some nice international launches during the quarter, so those net ads came in above expected. And they are actually one of the few that are starting to get to the inflection point where we're starting to see some profit. But again, it's so much smaller compared to their legacy TV business. That's still the bread and butter. And on the studio side, you're right. They had some good good results with Dune. They had a good launch with Godzilla x Kong. They also had some misses. Furiosa was one that didn't quite do as well. And of course, on the video game side, that's also been quite weak, especially against some difficult comps against last year with Hogwarts Legacy.
All right, $16.7 billion market cap. That's one thing. But then you look at the balance sheet, and they got $40 billion of debt.
Oh my God.
What is this company? I mean, John Malone's a shareholder,
right.
An agent of change, if nothing else. Is there an expectation in the marketplace, Kevin, that this is a company that needs to be restructured, split up, acquired? I mean,
it's certainly been speculated on. Management, of course, declined to comment on rumors like that. They're certainly prioritizing their cash flow to pay down their debt right now. Certainly, a lot of that is going towards their interest payments. It's difficult to say. It's really, really difficult. Obviously, when you look across kind of the media landscape, they are partnering together with bundling. Obviously, we have Venue Sports coming this fall. So
what's that again? Help me understand that one.
It's the streaming sports JV. Essentially, they're going to be it's like a skinny pay TV bundle. So essentially, you're getting those cable TV channels, but it's all over the internet, right? So again, that's Warner, that's Fox, that's Disney's ESPN.
But it's not NBC Universal.
It's not NBC Universal. It's not Paramount, CBS Sports.
It's a disaster. It's a disaster. We had, when I was running this industry, we had people paying their cable operator $100 a month. The cable operator made money. And the cable operator paid a lot of money to the Viacoms and Warner Brothers Discoveries of the world for their cable networks. They made money. Lots of big audiences. Advertisers made money. Everything was good. And then the young folks come into the industry and they change it. They start the streaming service, and now they're scrambling for dollars. Is there an expectation, Kevin, that we're somewhere near a point where it all shakes out or something?
Yeah, I think so. And you make it sound so wonderful back then.
Even I made money there.
Again, if you look at certainly Netflix is crushing right now. Their margins are so great. They just upped their margin guidance. Cash flow really, really strong, and certainly seem to be winning these streaming wars. But again, it's evolving, right? It's continuing. We're looking at price increases. Obviously, when you're looking at kind of a more mature market like the U.S., the focus is on ARPU. So how are you going to raise ARPU? There are a few different levers.
Average revenue per user.
Exactly. There it is. So you can do that through just price raises. Obviously, they're trying to build out their advertising like we were talking about before. And then the other big lever is the password crackdown. So Netflix did that last year. Disney's going to be implementing that in earnest, and so is Warner Brothers.
Has that been material? Like, did that?
Oh, yeah, no,
Certainly.
it really helped.
Yeah,
for
absolutely.
Netflix, yeah.
Very much so.
Okay.
Yeah, okay.
The Sweeney offspring were upset because they've been skating on my coattails for a long time.
I guess also then the question is, at some point, I don't know if we're here yet, people are just going to get fed up with all the price increases, of which I cannot keep track, and they're going to do the thing where they go through and they're like, no, yes, and they're going to start cutting. Have we seen that yet?
A little bit. Again, if you look at Netflix, their churn levels are so low compared to their peers, but you do see a lot of those serial churners. They'll sign up, they'll watch a show that they like, and then they'll cancel, right? So they're trying to combat that. They're still keeping, again, they being, most of these streamers, they're still keeping that competitive entry price with their ad-supported tier. So what they're trying to do is either you have to pay a lot for a premium product or pay less and watch ads.
All right, Kevin, good stuff. You can come back. You passed the test. Kevin Neer, Senior Media Associate Analyst at Bloomberg Intelligence.
No pressure.
I didn't hire him, but Geetha did, so that's good enough for me. That's all I need. He's here at the Bloomberg Interactive Broker Studio, and most importantly, he's based in New York City. None of this Princeton stuff. You want to be a player, you got to be in a big town. That's what I always say. Kevin Neer, thanks for joining us here.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.